First and foremost, why would I want an annuity? Well, I might be in a high tax bracket. I might want some safety of principal. I may not want to have downside risks. But the world of annuities is to provide portfolio protection to that percentage of a client's assets.
Need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I have a belief that each and every one of us has a right to financial planning and financial dignity. And I'm going to tell you now, if you fail to plan, you plan to fail. Let's get to it today. I'm being joined again by my fabulous producer, Allie. We're going to talk today in a two-part episode. Today, part one is going to be an intro to annuity conversation. We're going to talk about the different types of annuities, how people need or should be using annuities, giving them more education on the annuity side of their investments. Allie, where do you want to start?
Well, hi, everyone, first of all. Second
Welcome,
of all,
Allie.
Thank you. I am somebody who doesn't know much about annuities. So really just introducing annuities to me as, someone who doesn't know it.
Oh, beautiful. Well, you come to the right place. Pull up a chair and come to the old laboratory. So there's four types of annuities, but basically what an annuity is from an education standpoint, annuities are issued by insurance companies. Annuities are considered life insurance products. As such, annuities fall under the IRS tax codes that provide tax deferral. So annuities have been used over the centuries as a way to mitigate taxes and provide tax deferred compounded growth. Now you got to remember, in the early part of the 1900s into the post World War II, taxes were much, much higher than where we are today. And so getting tax-free investments using municipal bonds, there were no 401ks and IRAs until the 1980s. So people invested and they were taxed, or people bought tax-free bonds, municipal bonds. And so annuities were a way, as well as life insurance products, which we'll touch on in the second episode, of getting this tax deferral on their money. And then as time went by, annuities evolved. So back in the day, the most common annuity was used or derived in pension planning. People will hear the term SPIA, single premium and immediate annuity. So when people have pensions, and we talk about in other episodes about pension maximization and pension planning and selecting options with spousal survivorship components, I always tell people from the basic core, a pension is nothing more than an annuity. When you win the lottery, we should all win the lottery. When you win those big lotteries, what are they offering you? If it's $100 million prize, do you get a check for $100 million? No. You get an annuity payment for 20 or 30 years, equating to that total payment, right? The total prize. But if you want the money today, it's discounted. And so they might take a third or half off based upon prevailing interest rates. So what's happened here? The Lottery Commission has purchased a single premium immediate annuity based upon prevailing interest rates to provide you, the recipient, those 20 years of payments. That's a SPIA. That's a single premium immediate annuity. And that's how it works. So now why would somebody want to do it? What we've talked about over the years is, annuities today are not your grandfather or father's annuities. And in that regard is a lot of people don't want to lose control of their money. And back in the day, annuities had to be annuitized, meaning you gave them the money. The only way to get the money back was to get a payment. Well, I might want my money back. I might want to buy a car out of that. I might want to do other things with that money. I want to give it to my kids. So a lot of people in the 80s and 90s, shied away from using annuities in that regard. But then the products changed tremendously where you didn't have to annuitize. And so not too often do people actually annuitize their annuities as much as have income features that come from them. So first and foremost, SPIA, single premium immediate annuity, that's an annuitization calculation that's going to provide you maybe lifetime income. A lot of times it would be what's called period certain, 20-year, 30-year. So if the person died, what's the risk if you have a lifetime income stream? Well, what if I don't live? Right? So you give me $100,000 and I'm going to give you $1,000 a month for the rest of your life, whatever that means. Okay? Well, 3 months later, you died. The annuity company keeps the money. People are like, well, wait a minute. That's not very fair, but that's the risk. So then they came out with, 20-year period certain. What does that mean? Well, we're going to give you payments for a minimum of lifetime with a minimum of 20 years. So if something did happen to you, your heirs would get the remaining 19 years of payments. So the money wouldn't be lost. But that payment is less than a lifetime payment. So there's calculations. There's understanding how they all work. Does that make sense?
Yeah, no, that makes sense. One question that kind of came up for me is you started to hit on some of the benefits of an annuity. You know, the biggest benefit being that you go through your insurance company essentially to get it. So what are the other benefits, though, of an annuity over some of the other alternative retirement options?
Well, the tax deferral is a big one, but even in that regard, people will use annuities in IRA and 401k assets, and that has to do with protection. So if you think in the regards, if an annuity is issued by an insurance company, what is an insurance company known to do? Well, provide insurance. And so the annuity space, if you will, in general, and there's different products and programs out there, but the world of annuities is to provide portfolio protection to that percentage of a client's assets. So if you put your money in the stock market, if you bought an S&P 500 index fund from Fidelity or Vanguard or whomever, there's no insurance or no protection. You get the ebbs and flows of the market. You're going to take the hit if the market corrects 30%, market goes up 30%, you're going to make it. It's unbridled either way. An annuity, depending on the type of vehicle, might offer you some downside protection, might offer you some minimal performance measurements, and then based on the back end, might offer you some guaranteed income streams. There's a whole slew of things there you can, look into. So you have a fixed annuity. A fixed annuity is like a CD. So if you went to the bank and you bought a 5-year CD, you're going to pay interest every year on the CD, assuming it's a taxable account. Okay. If you bought a 5-year fixed rate annuity, usually the interest rate a little bit higher in a lot of cases than the bank, and the 5 years of interest is compounded tax-free. But there's a difference now, because when you go to remove the money from an annuity, the taxation is treated as LIFO, last in, first out. If you put $50,000 in an annuity and you have $10,000 of interest and you want to pull out $10,000, that first $10,000 is all going to be taxed as income until you get back to your principal of the original $50,000. Then that's return of principal. Versus maybe your stock portfolio, you have a capital gain. There's a share price. You paid 100. You sold it for 120. The 20 is taxable. The 100's given back to you. You have a basis in your stock sale. The annuity doesn't necessarily work that way. Now, if you annuitize, not to confuse everybody here, if you annuitize that $60,000 into income, 20-year or lifetime, whatever it is, well, now the interest is broken up over the payments, and the majority of that check every month is principal, because you're giving them the 60,000, 50 was principal. So now the cash flow is going to be much less tax implicated. So again, the nuances here of I don't want to get into the weeds. I think we're getting too deep in some of the stuff, but you got to look at the strategy, what you're using it for, what's the back end, why did you put it in, what's the intent when you get it out, and that's part of the planning process. So first and foremost, why would I want an annuity? Well, I might be in a high tax bracket. I might want some safety of principal. I may not want to have downside risk. So an indexed annuity will give you upside market participation. It'll follow indexes depending on the program you're in. The most common would be the S&P 500. And so you can get a percentage of participation against the S&P 500 index. So in 2023, if the index was up 20% this year, this was a pretty good year. I don't know what the numbers are, but let's just say it was 20%. Well, an index annuity may or may not, depending on the programs out there, you're not going to get that whole 20%. You usually have an annual cap. Depending on interest rates and the environment and the policies you bought, a few years ago, those caps were pretty low, 4, 5, 6%. Now they're back to maybe 8 to 10% or higher. So if I'm in a 10% cap, market goes up 20, I'm going to make 10. Still a pretty strong performance. But if the market rolled over and dropped 20%, I don't lose a penny. And so you're giving up upside to protect downside. And if you remember in one of our earlier episodes, we talked about asset allocation and rebalancing and your rate of speed and risk to your portfolio. If my financial plan says I only need to make 8% to reach my financial objectives, do I care if the stock market or other investments are making 20? Do I want the risk that comes with making that 20? Well, no, your financial plan says you only need to make 8. That's your rate of speed. That's your cruise control. I don't need to be driving 120 on the Autobahn. I don't need 20%. Give me my consistent 8. So now if the index gets you 10 this year and 6 next year and doesn't lose in the third year when the market capitulated and dropped, I'm staying in the game of making my consistent 8% a lot easier. Folks, it's not what you make, it's what you keep. Getting in is easy, getting out is hard. So when you build a portfolio, if you don't understand the risks that you're taking, you don't understand asset allocation and rebalancing, and you're not executing these things to protect your principal, eventually, as they say, all things end bad. Otherwise, they wouldn't end. Ever heard that one? All things end badly, otherwise they wouldn't end. So, a good stock market run is only as good until it's not. And now it's like, what have I done? So when you've done it enough and you've seen 3, 4, 5, 6 corrections like I have in my career, you always want to make sure the clients understand or have assets positioned out of harm's way. Now, again, in one of our previous episodes in the asset allocation, we talked about rising interest rates and the damage to bonds. Well, over the years when rates were so low, I was using indexed annuities as a bond replacement idea. Not going to make a ton of return. They were probably making 4, 5, or 6%, but that's historically close to what bonds were making. No downside to the principal. Take your money that should have been allocated to bonds, fixed income, and let's put it in an indexed annuity. You'll get some upside, but if the market corrects, no downside. If you had left it in a bond portfolio and rates went from 3% to 8% like they did, you're getting destroyed. Your principal's getting clobbered. There's nothing. You're going to ride that baby for years and years with really bad losses. And then the pain kicks in and the guilt kicks in. And then I don't want to keep looking at this thing that's down 80%. And then I want to get out and go do something else. Well, you can't afford to take an 80% loss if something like that happens. So why did you step into it? What could you have done differently? And so that's where the strategy would have come in, to use something like an indexed annuity or a fixed annuity. Now rates are higher. Interest rates are higher. Rates could be going down. Stock market might be due for a correction. Who knows? It's not a matter of if, it's a matter of when. And then we don't know how long. So Again, if you just had a 30% increase in your stock portfolio or 20% increase, should you be pruning? We're back to that asset allocation conversation the other day. Should you be pruning the tree and putting the money in safer vehicles? Well, annuities are construed to be one of those safer vehicles. Makes sense. Next question.
Yeah. So, when should someone start to consider purchasing annuities or getting into annuities? Is there an age where you normally recommend, or is it more just dependent on where you're at in life?
Well, that's a great question. And I failed to mention one key component, and that is withdrawals from annuities. Annuities are considered retirement vehicles. As such, there's a 59 and a half age rule, just like your IRA 401k. Meaning, if you're not familiar, that the government doesn't want you treating these investment vehicles like ATM machines. Technically speaking, if you have money in your 401k, you can touch it, you can pull money out. There's a 10% penalty if you're not 59 and a half. Okay. So the same is true with the annuities. Annuities have an age 59 and a half to it. So for a 30-year-old, putting them in annuity may not be the most appropriate vehicle. Depends what they're trying to do. But if there's a 59 and a half age limit from penalty, there's going to be tax. There's tax now, a 10% penalty. So you got to be prepared for that. So this is not something that you would say to me, I just want to do it for a year and I'm going to buy a house. These are not the products. That's what a CD's for, money market account, liquid assets, right? If you say to me, I'm 40, I'm putting this money away for 20 years, yeah, then that might make sense. Okay. So there are other products or vehicles, which I know you want to touch on in another episode, where you can leverage the tax deferral using life insurance strategies. But that doesn't come with age restrictions like annuities do, which is one of the big pros and cons. So good point there. Glad you brought it up.
Awesome.
You would, I mean, to put a bow on it, it's really annuities, I would say, would deem to be more suitable for somebody 40 and above and 50 and 60 and above. And that's because most annuity contracts are 5 to 10 years. And then what would happen is you would roll them over and renew another 5 or 10 year cycle. You know, there's 3, 5, 7, 10 year contracts. Okay. So an indexed annuity or a fixed annuity, the longer the contract, they usually give you a higher boost to the participation or the interest rate or something like that, because they have more time to make money. All they're doing is playing the spreads. They're going to take a little bit more risk than you're going to want to take, and they're hoping to make a couple points. So if they make 12 and they're obligated to pay you 9 or 10, well, other people's money, right? If they got $1 billion and they could make 2% free cash flow borrowing that money, right? Give us $1 billion. We'll go invest it. We'll give you 8%. We make 2%. That's the game, right? So they're management, asset manager professionals that take the money. Look, the insurance industry is probably massively larger than the banking industry. There's I think way more money in the world of insurance than, people even can imagine. It's interesting when you talk about fixed income, bonds, and that type of stuff compared to equities or stocks. And this is where the housing crisis became so precarious. There was so much more money in fixed income compared to the equities. And so when the fixed income market got sick, the equities just got blasted because the size differential, the volume of money in those vehicles dwarfs equities. And there's there's trillions in equities. So imagine how many more trillions are in fixed income. So if the insurance industry is leveraging 1 or 2 or 3% spread on the enormity of $1 trillion. It's a lot of, and that's the pool of insurance at its core, right, Ali? I mean, life insurance is a pool of money to pay claims. I've said this in other episodes. Term insurance only pays out 3% of the money. Claims are only paid 3%. It means most people don't die during their window of owning term insurance, 3% of the time. So 97% of those premiums are kept. That's probably a pretty good profit margin for them, right? Auto and homeowners insurance is a pool of everybody's money so that if your house burns down, we're going to use that pool of money to help you rebuild your house. And so they collect those billions of dollars. And again, they're looking to play the spread. And if they can make 2 or 3% or 4% on the $1 billion, but then when a hurricane comes in and wipes out the reserves and then some, well, now they're upside down. And that's why rates have to go up. They have to replenish the pool. And people just don't understand that. But it's insurance. You're asking somebody else to take the risk away from you. And that comes at a cost. Anything else? Any other questions on?
No, I think that was great for the introduction. I know we're going to dive deeper into this, but this was a good start.
All right, so we've been talking about an intro to annuities, the basic concepts of what annuities are for, where they might fit in the portfolio, tax deferral, the origin of annuities, the SPIAs, the income streams, most importantly, the tax deferral tied to the 59.5 and the LIFO. So a lot of different things we covered here. So I'll bring it to a close here. Ali, thanks for joining me today, folks. This has been another episode of Ask the Planman. Please like, subscribe, and share. Hit us up at 844-PLANMAN. Come to planman.tv. If this is bringing value to you, please share it with others. Until next time, if you need some advice, always get it right. Come ask the Planman. If you fail to plan, you're planning to fail. Don't let it happen to you. See you next time.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and